While we're waiting to officially start here, just thought it was pretty interesting the consumer price index report that came out today. Surprise for lower inflation than sort of the stock market had certainly been expecting. But it's a really good sign for the future that we're starting to see inflation ease a bit more noticeably, and certainly starting in really more categories showing that sign of disinflation or even deflation in some cases. Certainly metals prices coming down and some other things as well. So definitely an encouraging story there as we look off to the future. One of the trends we've noticed too in pricing is some of the things that surged the most in that pandemic period of 2020, 2021, the initial pandemic period, even early 2022. Those are some of the things that are starting to see the biggest corrections. And so that'll just be a trend to keep an eye on. But a lot of the markets that had the most upward boosts as well are now some of the ones that are seeing the toughest sledding on the backside of the cycle. Recreation equipment, things like that really were on fire at the start. Boats, RVs, furniture, things like that when we were all cooped up at home. Those are some of the most prone areas for correction, both pricing and activity. So let's dive in here. Again, I apologize for having to change the link there. So I really wanted to start with just a quick overview of what's going on in the economy, which is a lot. And it's really hard to make sense of it all because we've got some good news, like the new CPI report coming out. We've got an inverted yield curve. That's bad news. We've got good news. Third quarter GDP went up in the US. We have the stock market not doing so well, except for today. That's bad news. So it's really, really difficult time to make sense of all these things. So my objective today is pretty simple. I want to make sure that I'm going through both for the economy and for your markets, kind of the very good, the not so good, and the really pretty concerning. And I think we have things really in each of those four buckets right now, remarkably, and that's not always the case. The economy does always vary, of course. I've been at ITR now about 7-8 years now, and certainly not everything is behaving at the same point in the cycle at every point in time. But right now, I think it is fair to say things are a lot more varied than they normally are. And so I think it's just important to really frame that and think about that as a business of where can you get those opportunities, where can you avoid those pitfalls and painful areas as we move forward. So let's start where we always start, and that is the leading indicators. A reminder of why do we start with the leading indicators is because at ITR, we are a data-driven firm. We want to be really focusing on what the data is showing. And right now, it's showing amongst our best dozen leading indicators that 11 out of the 12 are signaling macroeconomic weakness ahead. And this is a pretty broad swath of indicators. You have your traditional US leading indicators like our ITR leading indicator or the OECD's US leading indicator there, fourth from the top. And then we have some other ones that are a little more global, JP Morgan Global PMI, for example, business confidence, housing, utilization rates. All of those inputs are signaling that there's going to be softening ahead for the economy. Exports are a little bit of a bright spot, but even those have some headwinds to them, strong dollar being one of them. And right now we have a trade deficit. Certainly it's less than it used to be a quarter ago, but it's still a trade deficit. So sort of good news there, but really on the whole, from a macroeconomic perspective, it's signaling a weaker economy ahead. Now, I think it's really important, though, to put that in perspective. And so I wanted to show you all GDP for the US, that's the blue line, and this is real GDP, so adjusted for inflation. And then in red there is Canada real GDP, again, adjusted for inflation. And I think it's just important to gain some perspective on why was it that we saw these 2 quarters of decline. You can see here in the blue line in the first half of the year, and then this bump up in the third quarter. Why is US GDP flattening? Well, Canada's GDP really is continuing to rise here, albeit at a more modest pace. And I think the answer to that lies in how we came out of the COVID period. So you can see pretty clearly in the red line here, boosting out of the second quarter of 2020 shutdowns, but then very quickly Canada GDP rounds over, and it really doesn't go up like a rocket. It really has a kind of a sluggish recovery out of the gate, except for that third quarter of 2020. Not a huge boost. It's harder to see, but behind it there in the blue line, the US really maintained a very aggressive V coming out of that pandemic period. And so what we're starting to see now in some industries, we were talking a little bit earlier on about things like patio furniture or RVs or maybe boats, things that people were just buying a ton of housing. That's a great example of a category that was just going nuts in 2020, 2021, so much growth. Those now are taking a bit of a backseat, particularly here in the US, because we had so much stimulus, both from the Federal Reserve and from the federal government, that of course we were going to have a little bit of a hangover, a little bit of a sugar high coming off of that. And so those are the sectors really that are driving some of this flatness here, relatively speaking, in real GDP. So weakness for sure, but it's sort of bound to happen because you can see right the sharpness of that blue line. You can't continue at that pace. So we're going into this weaker period, but coming from a period of strength is how I would distill that into a few words. Now, if you want to be optimistic about the future of the US economy, I would suggest looking at some of the consumer fundamentals and also corporate profitability. So if you look at consumer loan delinquency rates, they're really, really low. If you're looking at autos, it's at a 5-year low for loan delinquencies. Credit cards, very, very low, exceptionally low, just off of record lows at 1.71% there. And then same for the housing market. So even though the housing market is experiencing some pain right now in terms of home starts and home sales and things of that nature, people by and large are doing a really good job keeping up with their mortgage payments, keeping up with their credit card payments, keeping up with their auto payments. And so that's a really good sign that the consumer is not over leveraged. This is not a 2007 situation. We are not headed for Great Recession 2.0. We're headed for a weaker economy, but we are starting from a position, especially on the consumer side, of real strength. Corporate profitability, a really similar thing. When you look at non-financial firms' corporate profits for the second quarter, we don't quite have the third quarter figures out just yet. Those are at a record high. So plenty of cash available out there for businesses and for consumers. And that's going to be really the silver lining in this business cycle. That yes, we have those declining leading indicators. Yes, we are not able to keep up that rocket pace of growth that we rocketed out of the pandemic from here in the US. But it doesn't mean that we aren't in a strong economic position overall, just not as strong as we once were. So when you look at GDP relative to inflation adjusted retail sales, that's the green line, you can see right now that both are clearly in a slowing growth trend. So anything above 0 means year over year growth. So we have 3.6% year over year growth in retail sales adjusted for inflation, but clearly that's coming down from the stratospheric double-digit heights of late 2021, early 2022. Couldn't possibly keep up that pace of rise. And as consumer spending slows, that is also leading to slowing growth overall in real GDP. We've had some couple of quarters tick down in the first half of the year, very, very mildly. A nice bounce back in the third quarter. But overall, again, if you were just to go back a couple of slides to that blue line, if you look at the 3-month moving average there, it's pretty flat overall for US real GDP. And so some good parts of the economy, some tough parts of the economy. When you think about some good parts right now, what's going on? Service spending. Consumers are spending a lot of money on services, and that is certainly boosting the economy. Some of that money is being eaten up by inflation, but even on an activity basis, our spending adjusted for inflation is rising. So that's an area of strength. Some of the areas of concern, though, are the housing market. We already talked about that a little bit. Certainly affordability headwinds there. When you think about mortgage rates, how high they've gone here, one doubling here this year, that's a really tough move for consumers to swallow. Another part of it too is home prices are still pretty high. And so if you have high prices, high mortgage rates, it's gonna be really tough for residential construction markets and things of that nature. And we'll see how that manifests in construction machinery orders and some of those markets that you all care more about a little bit later. So slowing growth overall, consumer is bending, but they are not breaking. That's the thesis that I would want you to walk away from here. In terms of our forecast, you can see some more deceleration ahead. We get pretty close to that zero line before we crawl out of the downturn or softening period here, late 2023 into 2024. So that's really where we're headed from a big picture baseline perspective. Let's get a little more focused though on business activity. So when you look at business spending, this is non-defense capital goods, new order spending on machinery, some large sale electronic items, for example, going into businesses. You can see on a year-over-year basis, this is performing very nicely. We're up 10.2% year over year. That's the upper green line here. And then on a 3/12 rate of change basis, that's the most recent 3 months relative to those same 3 months a year ago, we're up 8.4% year over year. That's pretty impressive when you think about it, with all of these macroeconomic headwinds that we've got going on, higher interest rates, high inflation, businesses certainly beginning to feel some margin pressures. They're still going out there and spending 8.4% more for the most recent 3 months of new orders than they were a year earlier. Pretty impressive stuff. So that's the impressive side of this. I guess the less impressive side is a lot of those dollars are being eaten up by inflation. That's probably no surprise to you all. If you were to see this same picture on a deflated basis, on an inflation adjusted basis, instead of having this nice rising trend in the 12-month moving total that we have here, you would start to see it flatten out in 2022. So I think this has some real repercussions for you all on this call. And that is, you've got to be really careful that when you're tracking the rates of change for your business and its segments, that you're doing it not just on a dollar basis, but on a volume basis as well. So you want to be making sure that you see those two differences and are taking that into account when you're doing your business planning. Okay, so let's take a quick peek then at the overall industrial sector for the United States, this US industrial production. So this is about 3/4 manufacturing, and the remaining quarter is split roughly between mining, mostly oil and gas here in the United States, and utilities. Doing very nicely as well, up 4.5% year over year. Not as high of rates of growth as business to business spending, of course, because this does not include inflation, but growing rather nicely. We're seeing plenty of manufacturing activity going on here in the US, plenty of mining activity going on here in the US. Utilities market is doing all right too. And when you look at the rates of change, we don't see much in the way of deceleration. We're seeing slowing growth. You can see that green line begin to come down in our bubbles. That's our forecast, show that slowing growth will continue into the back half of 2023 before we see a mild upturn here in 2024. But not looking for this to dip below the zero line just yet. You'll notice though, down here on the lower right-hand portion of your screen, you can see a red bar drawn at the end of 2023, early 2024. You might wonder why on earth is that red bar there? Well, that's there because that's about the time at which all of these interest rate rises that the Federal Reserve has been putting through are really going to weigh on industrial production. So we have our current forecast based on an assumption that the Fed will very quickly be able to slow their rates of rise in the Fed's funds rate. We won't see interest rates really go too uncomfortably high. We'll see inflation come down quite a bit. We'll see the supply chain repair itself, and that's going to enable us to have this soft landing that we have built in for the base case. The problem is when we read Chairman Powell's statements, and statements aren't actions, but statements, he and the other Federal Reserve Board governors certainly seem very inclined to keep raising rates. We'll see if they change their tune or not, but if they keep raising rates, we're going to have a problem getting back into this growth trend in 2024. They could absolutely over-tighten us into a more painful downturn. So that's the biggest risk that we see to our forecast right now. And it's certainly something we'll talk about how to prepare for. But let's really dive into those risks, because remember at the beginning, I said, we've got the very good, we've got the pretty good, we've got the not so good, and we've got the real problem spots in the economy. So let's think about what some of those are. So on the very good side, if you're an employee, and the not so good side, if you're an employer, is the tightness in the labor market. When you consider the number of job openings, even with all of the pain that's going on, in the global political system, in certainly inflation, interest rates, all these shocks, job market is remarkably tight. So we have about 2 job openings for every 1 unemployed person here in the United States. And what that means is that it's fueling a labor market that is producing real personal income that has record highs. Even adjusted for inflation, real personal income is at record highs. That's a remarkable fact when you think about how high inflation is right now. The personal income adjusted for inflation is at record highs. So what's that doing? That's fueling all that retail sales growth. It's fueling the consumer and really powering our economy forward, even though we're experiencing all those headwinds. Of course, if you're an employer, this is a tough thing because you've got to find those workers. And if you find them, they're expensive to train, they're expensive to retain. So this is going to be an ongoing fact for going forward. It's not going to be uniform. We're already seeing labor market weakness in certain pockets of the economy. Tech comes to mind. I just saw Meta or Facebook laid off people. Certainly the tech firms are not in a good spot right now. But when you look at more industrial type firms, what we're hearing a lot from them is we just can't find the people still. So be prepared for labor market tightness in the industrial space. It's not going to be a easy way out. And part of the reason for that is despite all these economic factors that are going into it, we have people and the baby boomers in particular getting older and older and older. Youngest baby boomers right now are about 58, 59 years old. And as they get older, closer and closer to that 65, we're going to be having more and more boomers going into that retirement phase of the labor market. And so that's just tough math because there's a lot of baby boomers and we don't have enough people coming in to replace them, particularly in the industrial sector. And so that just makes tough math for employers, definitely a competitive labor market. But the sort of silver lining of that from a macroeconomic perspective is that we have those wage gains to fuel spending in the economy. And that makes it a very, very different thing than back here. You can see here in 2007, 2008, right, we were at about 2 unemployed people per job opening versus 2 job openings per 1 unemployed person, almost the reverse situation, right? So very, very different dynamics right now. All right, so that was in the macroeconomically speaking, good or even very good category. Now, here's a chart that really underscores this is the thing that is keeping us up the most at night here at ITR. And that is we're now seeing an inverse yield curve. So what does that mean? It means short-term rates, that's the teal line here, are running above long-term rates. That's the navy line. That's not supposed to happen. It rarely happens. And what it means is that investors are more concerned right here about this near term, and they're demanding more returns in order to be here in that near term part of the the yield curve. Longer out, right, the rate of return is lower. So that tends to be a recessionary signal. You can see these two areas that are circled on your screen. We saw the teal line go above the navy line and stay there for a while, going into the 01-02 recession. We saw the same thing happening going into the Great Recession. So this isn't good news. And that's part of why we have that red line. Again, just to go back to our industrial production chart one more time, you can see this off to here. This is really putting late 23, mostly 2024 at risk for our forecast. So we'll definitely see some deceleration here in the near term. That's not going to be too affected by what the Fed does. It takes a while for interest rate changes to trickle through the economy. It's further out we need to be worried about. And so that's really what we're keeping in mind here. Now, one question we get asked a lot is, well, why aren't you changing your forecast this very minute? Well, it takes a while for this effect to take hold, and we need to see a sustained inversion in the yield curve. So it can't just be for a day. It needs to be for about 2 months that we see this sustained yield curve inversion. That's the real reliable harbinger of recession. So we're certainly keeping a close eye on this. And when we think about what that's meant economically, certainly one of the most painful things it's meant, I mentioned already, was housing. So when you look at these high mortgage rates and high prices, that's pricing a lot of home buyers out of the market, and builders are responding by building less homes. So right now, if you look at the most recent 3 months of single unit housing starts, they're down 18.2% versus those same 3 months a year ago. On a year-over-year basis, 12 months over prior 12 months, it's down about 5%. And you can see the dip in the 12-month moving total here at the bottom portion of your screen. So certainly those affordability headwinds are driving things. I will share with you, though, it's most certainly not uniform across the United States. If you're on this call and you're on the West Coast, or maybe you're in some of the Mountain West states that really saw those big price increases, I'm thinking of the Utahs, maybe the Colorados of the world, or maybe you're down along the coasts on the eastern seaboard. Those are the areas that are most likely to be seeing this pullback because they have high home prices in them to begin with, have already seen this sugar rush happen, so they're most likely to have the hangover from the housing market pulling back. If you're in more of the Midwest, certainly a place that has low home prices, Alabama or West Virginia, you don't need to be as worried about this because those housing markets are more stable, both on the upside and now thankfully on the downside. So that's an important factor when you consider your planning, is where you're located, where your customers are located. Should you be a little bit more bullish or a little bit more conservative about your projections for the future? Certainly take that into account. And then the last thing I wanted to share with you on a risk perspective is looking at corporate profits. That's the green line relative to the stock market, in this case, the S&P 500, that's the blue line. This is on log scale, and no, I'm not testing your knowledge of K-12 mathematics. You guys don't have to worry about that. All you need to know about log scale is you can compare the rate of rise across time. Otherwise, this graph would look goofy. You wouldn't be able to do that very effectively because of inflation. But what I want you to draw your attention to is this gap between where the S&P 500 is at and where corporate profitability is at. We don't like to see this gap because it means the stock market's overvalued. Good news is, from a sort of longer run perspective, we've seen that gap narrow a bit from where it was at the beginning of the year. But if we see this gap close completely, that's kind of a downside risk to what we're seeing in the economy. That could really cause consumers to pull back. So even though they have these low loan delinquency rates, they might not be as inclined to do that if their value of their portfolio really comes crashing down. And I'm talking significantly more than how much the market's down already. So that would be a complete closing of this gap. And you saw that happen back in the dot-com bubble. It took a while, right? But eventually that dot-com bubble burst completely and we saw these two trends realign. That would be the downside risk there. So just to kind of wrap up those risks, we've got very nice consumer being fueled by a tight labor market. They have low loan delinquency rates. That's the good in the economy. And they're fighting it out against Federal Reserve raising interest rates, a stock market that's overvalued, and housing market that's taking it from those higher interest rates. So competing forces, and what does that mean? It means slowing growth, flatness in GDP at the bottom of this cycle. It's going to mean some recessions in some markets and some soft landings in some other markets. So that's kind of the macroeconomic picture. Let's pivot quickly to inflation. I did want to really drive home the case that the pricing environment of 2023 is not going to be the pricing environment of 2022. If you're planning for 2023 to have the same pricing environment as 2022, I would really encourage you to revisit those plans, because the evidence is quite clear that we are going to see inflation ease pretty significantly next year. So here's fact number one for why we believe that. And what you're looking at in the light blue line is the Global Supply Chain Pressure Index. This is put out by the New York Federal Reserve. And what you can see is anytime that the light blue line is above zero, that represents supply chain tightness, more tightness in the supply chain than average. Anytime it's below zero, it means a looser supply chain than the long-term average. And clearly you can see as soon as COVID hit, right, giant surge in supply chain tightness. That's because when you don't produce anything, of course, there's going to be supply chain problems. And then sort of the economy opens back up and we see supply chain pressure go down. And then we get 3 rounds of stimulus and a bunch of Federal Reserve easing, and right, we go up to about 4 standard deviations above the norm for supply chain tightness at the end of last year. Unbelievable, right? 4 standard deviations above the norm is a lot. But we're going back toward normal. Now, what are we seeing? We're seeing supply chain loosening up. We're now just over 1 standard deviation above normal. So we're getting back toward normal. And what does that mean? It means that the navy blue line, which follows the supply chain tightness by about 10 months, is going to be moving downward over the next 10 months. We're going to see inflation coming back down here. You can see these little bubbles. That's our forecast. That's signifying that we're going to see those supply chain pressures ease. And as a result, we won't be competing over so few goods and bidding up prices in that same way. So inflation is coming down. What's our outlook for it? Our outlook is for easing inflation off here into end of 23, early 24. That's probably about when we'll see the bottom of the inflationary cycle. What got us into this in the first place, right? Monetary policy very loose, very tight labor shortage, huge commodity price escalators. We had triple-digit oil, we had very expensive copper, very expensive steel, and of course we put through a lot of fiscal stimulus as well. Factors 1, 3, and 4 have changed considerably, right? We are tightening monetary policy. We've seen significant pullback in a number of commodities. Oil, not quite so much, but most other commodities, a pretty significant amount. And then we're no longer doing the same types of fiscal stimulus that we were during the initial period of the pandemic. The labor shortage, though, we already talked about that. You can't change demographics. And the demographics say that we're going to have this labor shortage persist. So what does that mean on the whole? It means inflation's certainly coming down, certainly going to be moving more toward a normal range, but it's still going to stay elevated. We're not going to be going back to this 0% inflation, 0.5% inflation, 1% inflation that we grew really accustomed to in the 2010s. That's not our future here. And you want to be prepared for that sort of middle road of not as inflationary, but still somewhat inflationary. Another factor that really leads us to believe that this inflation will ease significantly is when you look at government spending. That leads this consumer price index by almost 2 years. And so as we saw the stimulus go away and we saw pullbacks in some areas of spending like For example, spending related to the war in Afghanistan, we're not doing that anymore. That's easing back on that kind of pressure. And so that's going to lead to lower inflation eventually here and lead us down more toward a normal environment. And then lastly, just to talk about those commodity price escalators, you can see right back at the end of late last year, even early this year, the rates of change for steel scrap, for crude oil, for copper, for plastics were really, really high. Now, a number of them are below the zero line, most notably the metals. And oil is easing in its ascent as well. In fact, downright easing it on a year-over-year basis, downright contracting from where it was a couple of quarters ago. So just some signs there that we will see that inflationary picture ease. So why do I say that, and why do I bring this up? Well, two things really. Number one is we do think that gives the Fed latitude to ease back on their interest rate increases. We'll see what they do. We really, of course, want that to happen because we want to see that soft landing for the economy going forward. The other thing, though, is I was talking about your pricing plans for 2023. It's going to be getting harder and harder and harder to pass along those price increases. Also, from a wage perspective, you'll still need to put through wage increases, but the huge wage increases, that wage growth is going to slow down as well. So you want to be prepared for just a softer in pricing environment come 2023. If you can pass along your costs now, you're better off doing that than waiting, because you're going to get more and more resistance as time goes on and people see inflation easing to you raising your prices. So you also don't need to be worried as much about putting through quite the same escalators in wages that you did of late. So pricing environment's changing both on the input side and on the output side. So make sure you're managing that very carefully. All right, I did want to talk about one other tailwind. This falls in the good news category, and that's onshoring. This is an interesting map here of manufacturing costs. And I think the big takeaway from me here is when you look at the US, that's the third bar from the left at 100, and you compare us to China, China is only mildly less expensive, right? We have an advantage certainly over Germany, cost advantage over Germany. We have a cost advantage over France, over Italy, over Belgium, over Switzerland. We even have a cost advantage over Spain. We are on par with South Korea. So the US compares decently well on a cost perspective. And of course, we have the big attribute of being located immediately next to the big consumer base here in the United States. And so what does that mean? It means people are going to be interested in bringing manufacturing here to the United States. And when we look at the sorts of industries that are involved in that, we don't have yet 2022, 2023 data from our friends at the Reshoring Initiative, but clearly a host of markets that are bringing manufacturing activity here to the United States. It's on an upward trend, and that's just going to be building momentum here as companies look and they say, you know, we cannot have our supply chain be as vulnerable as it has been in the past. We need to locate here in the United States. So this falls very much in the good camp in terms of providing opportunity to US firms as companies look to secure that type of business. And that's one of those reasons we have some pretty nice growth rates still built in for industrial production, despite some of these other headwinds from the Federal Reserve and some other forces. So just a good sign. All right, so let's wrap this up and then get to your markets here. So tailwinds, reshoring and strong consumer, those are first and foremost. Significant disparities going on right now between dollar-based measures and volume-based measures. When you think of, say, non-defense capital goods, new orders, right? Dollar-based value is rising rather nicely, volume is flattened out. So make sure you're paying attention to that. And the number one risk that is keeping us up at night is the Federal Reserve. So what should you do? One thing we get asked a lot is, well, should we be spending money right now? Should we not be spending money? What should we be considering? I would urge you to focus your dollars on things that are really going to make you more efficient, particularly when it comes to labor. If you can find something that will save on labor costs, we know no matter what goes on in the economy, demographics, you cannot change demographics. Demographics were set in stone decades and decades ago when people had their kids. So when you think about that tight labor market, think about how you can become more efficient at what you do. And then the other thing I would really urge you to think about is having what I call a Fed plan. You saw our baseline industrial forecast where we have slowing growth, but not quite recession. Have a plan for if the Fed continues ratcheting up rates significantly and pushes us into the recession conditions. We may have to change our forecast in the next quarter or two, given that. And you can bet that you'll hear that trumpeted loud and clear. And what I'd want you to do heading into 2023 is have your base case, and then also have your if the Fed tightens too far case, where you say, okay, we thought about doing this. We're not going to do that anymore because it's too expensive. We need to conserve the cash. We thought about doing this. We're not going to do that anymore. We're going to conserve the cash. And we know that consumers are going to be even more price conscious. Our customers are going to be even more price conscious. So we're going to try and target them in this way in a recessionary environment. So have a plan. Doesn't mean necessarily that we'll have to execute the plan. We're all going to hope that the Federal Reserve takes their foot off the gas pedal, that yield curve uninverts, and we see a soft landing. But you need to have that plan at the ready so that once, if that event comes, you aren't caught off guard. Okay, so take a pause here to see if there's any questions. You're welcome to put them in the chat and give everyone a chance to catch their breath a little bit before we tackle the markets. Not seeing anything come through, so let's take a look at you all. So here's the MTI data. You can see on the left-hand panel of your screen, your data trend is rising nicely. You're in phase B, accelerating growth still, barely. The growth rate's really flattened out. You're kind of on the cusp of phase B, accelerating growth, phase C, slowing growth. And when you look at where you're going though, you'll be seeing those growth rates drop off appreciably and just slip below the zero line. So entering into this pretty mild recession. That's going to be a function of some of your markets having recessions, some not. It's going to be a mix. And we certainly, of course, hope that in this presentation, you'll be able to focus your actions on some of those markets that don't have recessions coming toward them so you all can outperform. So in terms of the forecast, we did change it slightly. That's been in place for a long time, but we did change it slightly to reflect a bit higher growth rate this year. That's really due to inflationary pressures. And then really lower 2023, 2024. So when you look off into the future, that's that Fed impact starting to come late 2023, but particularly 2024. Where we don't have the same growth opportunities that we had before this Fed tightening. So that's the forecast, and really what to prepare for is that mild recession on the whole for the industry. So in terms of your markets, construction machinery, this is a market that's doing quite nicely right now, but that's going to change, not in a catastrophic sense. We're still going to be doing a lot of non-residential building. And so that's going to be a tailwind to some construction machinery markets. But certainly on the residential side, that's going to lead us into recession. This series normally does go into recession. You can see recession is pretty common here for construction machinery, highly cyclical. People rent instead of buy on the backside of the business cycle, and this will be no exception. So, certainly a market where we'll be seeing that momentum change. But not in sort of a great recession type way. So some softening there. If you're highly exposed to this area, this would be a good one to try and find another market, maybe to balance out your book of business if you are able to. Not just for now, but really for the future as well. Highly cyclical, makes it hard to run your business. So don't want to be too exposed here if you can help it. In terms of North America light vehicle production, this is one of the hardest hit markets of the pandemic. Even was declining going into the pandemic, you can see, and then just the supply chain problems here on this data trend have absolutely decimated activity, but that's starting to turn the corner. We're starting to see semiconductor lead times shorten. We're starting to see the supply chain loosen and those parts being able to get out to manufacturers, being able to complete those cars. And that's going to lead to double-digit growth this year and next. That's really counter-cyclical to what's going on in the economy. You can see we still don't get back to record territory here in the 12-month moving total. So it's not as if this market is going to be screaming, but it certainly does offer opportunity to sort of offset some of the weakness going on with those declining leading indicators, that waning macroeconomic momentum. And it's really a supply chain driven thing that's allowing this market to improve. Very similar story on the heavy truck side. We're seeing not quite double-digit rate growth this year, barely double-digit growth next year, but that's all that supply chain improvement. You can see the 12-month moving average does trend higher here for the next couple of quarters, but then it dips, and that dip is driven by the fact that you're going to have certainly macroeconomic weakening, and also just the transportation market in general has some tough fundamentals. Definitely an acute labor shortage. Now shipping rates starting to slip, and so it makes for a tough mix for those transportation firms to go out there and upgrade their fleets. But sort of the existing book of orders is definitely going to continue to allow for some momentum over the next 3-4 quarters here until we see those backlogs sort of carry out. Not backlogs, I should say. The heavy truck companies haven't taken orders until they've been confident that they can fulfill them. They just opened their books for 2023 orders, and those are coming in, but we don't expect we think once that sort of surge of orders that people would have placed orders had they been allowed to, once that dissipates, there'll be a mild pullback here. You can see that here on the chart as well. In terms of oil and gas production, this is, if I had to pick one market for opportunity, I would pick this market. In terms of prices, we all know very high prices still for oil, high prices for natural gas. Europe is looking to do a complete energy conversion to wean themselves off of Russian sources. And so that, and then you've got OPEC cutting production, really just lends itself as an opportunity here in North America and the US in particular to do more oil and gas extraction. So growth for the next 3 years here, if you want a market to target, I think this is a fine one to choose. Medical equipment also growing rapidly, certainly zooming out here of the pandemic. Overall, we expect growth. There'll be a little bit of a downturn here in 23, but overall growth here over the next 3 years as we look to this aging population of baby boomers I already talked about. We've got to take care of those folks medically, and that's going to lead to more equipment being produced. So this is a nice market because it doesn't beat to the same drummer as the overall macro economy and a lot of your more industrial facing markets that you all are in. So if you want a market to sort of balance out some of the things going on in some of your other markets, this is a fine one to look into over the long term. So just something to consider there. And then looking at aircraft, similar story to auto, except even more acute. We had a bit of a crawl out from the pandemic, but just never really got much ground going here. Really, we're just going to see more of the same, crawling out slowly. Airlines are still dealing with a lot right now in terms of labor shortages, a lot of certainly headwinds and uncertainty in that industry, and that's going to make them reluctant to place a bunch of orders here just yet. So this is going to be a slow, steady climb out, compared to certainly the robust activity we saw middle of last decade. And then last but not least is computers and electronics. This one is very interesting right now, up 4.9% year over year. When you look at the dollar-based data as we are here, you would say, oh, nothing is wrong here. Everything looks great. But when you adjust for inflation, this new orders trend is declining. And when you look at production, it's flattening as a result. And certainly, if you consider We already talked about the labor market weakness for tech. All you have to do is look at any tech company's stock price performance year to date. It's been a very, very, very challenging year. Tech firms don't like high inflation. They don't like macroeconomic uncertainty. And so that's creating difficult conditions for this environment. I did want to call out, we did adjust this forecast since we sent out your last report. We got new data in between then, and we didn't change it very much, but slightly higher growth rate here for 22 and slightly lower growth rate for 2023. Overall shape pretty darn similar, but slight change there from what you'll see in your MTI report. This is the most up-to-date version that we have here right now. Okay, so just to wrap that all up, what are you seeing? I think you're seeing certainly that supply chain tightness loosening, increasing, and that's benefiting automotive, it's benefiting heavy truck, it's benefiting some industrial markets too, but those two in particular that had, were just unable to satisfy the demand, those are going to see some tailwinds as a result from that. Markets that aren't going to do as well, certainly tech, certainly airlines, and oil and gas is where to really consider opportunities there for you all. I did see a question come in on EVs. Where do we see that market headed? So I think that's a really interesting one. We had a robust conversation on that yesterday, actually, as a matter of fact. So thank you for asking that question. When you look at EVs now, they comprise 5% of annual sales for US automotive market. Pre-pandemic, it was about 1.5%. So market share is rising rapidly in an exponential fashion. Certainly in terms of market demand, that looks likely to continue. The impediment is going to be the ability of the utilities infrastructure to support electrification. And so in terms of, we would need to put in significant investment dollars for everyone to be able to charge their EV at home. So demand certainly super strong, but at some point we're going to start really stressing our electrical supply system to a point where we may have to slow down and or invest more in that and be able to satisfy that demand. So it's on an exponential slope. It's just a question really of supply more than demand is where I see that going. So in terms of overall, we talked about price consciousness. 23, 24 plans. Do you have that Fed plan? Are you taking into account your market mix? Are you taking into account your regional mix, knowing that the coasts by and large are a lot more exposed to housing market pullback, for example, than the Midwest? In terms of takeaways, supply chain issues are easing. Inflation is going to be easing as well. It's not going to go away because of our labor shortage. But certainly when you look at the consumer, they're in a really nice spot. They have low loan delinquencies, and so they can afford to take on more debt to get through this painful time of high inflation. Certainly something we're keeping an eye on is how well they're able to keep that up, but right now it looks to be in pretty good shape. Federal Reserve is certainly going to break the inflation rising trend. The great question is, how long do they keep this up, and do they break the macroeconomic growth trend as well? So that is something why, again, I mentioned you need to have your base plan and your if the Fed over tightens plan, and we will certainly let you know if we have to change our forecast to reflect what the Fed does or does not do. And then last but not least, when you think about this decade sort of zoomed out, what are some trends that we know are going to be going on in the 2020s? We know that it's going to be an inflationary decade. We have protectionism going on. Certainly, whether you're looking at Ukraine and Russia or China and the US, there's a lot of geopolitical conflict. And what's that doing? It's driving countries to produce more domestically and having that chilling effect on trade. That has some good things to it, it has some bad things to it, but most certainly it has an inflationary component to it. We also have a labor shortage as the baby boomers retire. We know that's going to lead to wage inflation overall, and certainly going to make finding those workers and retaining them expensive. So anything you can do to stand out in an inflationary environment, leaning into those competitive advantages, making sure that you're able to maintain your margins in an inflationary world is going to be really important. And I'm really thinking of that, not just like a year out, because we know inflation's easing, but as we think about 5 years out, 10 years out, how are we going to be ready for this world in which baby boomers retire? We have inflation, we have tight labor market, we have protectionism. You have to be able to thrive in that environment. So thinking kind of that big picture sense, I think is really important too, as you lay your plans for the next few years here. So hopefully that helps give a good sense of where the very good in the economy is, where the pretty good is, the not so good, and the real concern. I hope that clarifies everything, but I'd be so happy to answer any questions that you all might have that I didn't get to. So please feel free to drop those in the chat and I would be happy to answer them. And I think of the big topics we've been getting lately from clients, certainly concern about seeing recession risk in the news. First and foremost, I think supply chain, people talking about that, pricing, how to price. So hopefully I give you some good ideas there. I don't know if there's any other questions. Looking like maybe not. Okay. Well, thank you all. I hope this was helpful. Please feel free to reach out if you have any questions. I'd certainly be happy to answer anything privately if you have anything, and good luck out there. Take care, everybody.